In this video, we're going to discuss how high-income professionals can leverage real estate to avoid W-2 taxes. Now, if you're somebody who's got a normal W-2 job, physician, dentist, engineer, lawyer, and you want to figure out how you can invest in real estate and then use it to offset your taxable income, then this video is for you. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race. Do me a favor, download our passive income guide with the link below this video. Now, if you're already a high income professional, then you're more than likely used to paying a lot of money every year to your Uncle Sam. Now look, the wealthy have been playing a game. They've been playing a game with real estate for years, which is originally what attracted me to real estate in the first place. But it wasn't so much the cash flow, but it's that they know that it comes with so many different types of tax advantages. Now, more than likely, you were probably like me. You were never taught about how real estate can be used to avoid taxes. You were just taught to what? Go to school, make good grades, get a job. Hopefully that job will pay you a lot of money. And that, you know what? Taxes were just a part of being successful. But I'm here to tell you today differently. Now, I want to make sure that you understand that real estate is an investment that's going to help you avoid taxes on other sources of income. Now, let's start off by actually laying down the groundwork down on what's called the passive activity loss rules. So this is where it all starts, the passive activity loss rules. And I can guarantee you, just like me, that they didn't teach you this in school. Now, what are the passive activity loss rules? Well, this is actually a very complex set of tax laws. Look, I'm not a financial advisor. I'm not an attorney. I'm not a CPA. Don't take this as financial tax advice. Speak with yours before moving forward with anything. I'm just here to educate you. As I'm getting it in, I want to put it back into your hands as well. So the passive activity loss rules is a complex set of tax laws that's actually been in place since the 1980s, which is something that you're going to need to understand really before you even start investing or getting into real estate. Now, the first thing that I want to talk about is the difference between passive income and non-passive income. So we've got a couple of buckets here. So we have our non-passive and we have here are passive. Okay. So here's the crazy thing. This isn't even taught in school either. Okay. You go to school to make money and yet they don't even teach you about the different types of money. Okay. But I'm not going to go there. But back in 1987, President Ronald Reagan, he actually implemented the Tax Reform Act, which actually got rid of a lot of the tax loopholes, and it also implemented these passive activity loss rules. Now, what this did, this separated out the non-passive income with the passive income. And that, my friend, is how the IRS defines their, the money or the income in their tax code. That's how it's defined. So from our non-passive income, you're probably very familiar with this. With this bucket, it's filled with your 1099 income. It's filled with your W-2 income. If you have any type of stock income, maybe crypto, maybe some of the Social Security income, which is mind-boggling to me that you work your whole career, you have the Social Security income taken out of your check, then when you get it back to you when you need it, they tax you again. That's right, they tax you again. Okay, so anyway, in essence, this bucket right here, this non-passive bucket, this is filled with all the things that require us to do work, okay? We are required to trade our time for money. Me as a periodontist, I have to go treat patients. I have to trade my time for the non-passive income, I have to trade my time to make money. Now, these types of income are subject to different taxes. You got your federal tax, you got your state taxes, and in some cases, you're going to have Social Security, Medicare. Now, with me as a practice owner, I'm self-employed. For me, I would have to pay self-employment tax as well. All right. Now, that is a non-passive. So now let's take a look at the passive. Now, this is income that you receive from work that you're typically not doing. You're not actually having to go treat patients. You're not having to go service clients or customers when you're earning passive income. You typically make money over here at your W-2, you make active income. So you can take this, you can invest your money into things like rental property, okay? You can put money into rental property, all right, in which you do not materially participate, okay? So you do not materially participate in, all right? So if you're investing your money into a business or into real estate, it's going to be considered passive. And normally, again, this is rental real estate that we're looking at, okay, over here on this side. Now, one of the things that we have to understand as it pertains to non-passive income versus passive income is that the government, it actually creates this line. It creates this division or line between the two. Now, and it states that your passive income, okay, your passive income and any passive losses that you can get from your rental real estate, basically by depreciation, which we're going to get into shortly. Hang tight. So any of the passive losses that we get from our passive income, it cannot cross over to offset your non-passive income. So if you get losses, if you get passive losses, it cannot cross over on this side, okay? So now the losses that you generate from rental real estate, again, cannot offset gains from other income sources. Now, this is one of the biggest areas of confusion for my new members of my Passive Investor Circle group, because they come in, they see me investing into these real estate syndications for passive income. Okay, so they get into the syndication thinking, okay, this syndication and the depreciation I'm going to get, it's going to help offset some of my W-2 income, some of my dental income, some of my physician income, whatever. And I have to tell them that rental real estate cannot offset your active income. Now, I understand that if you're new to this concept, you may be thinking, okay, Jeff, why in the world would I want to be at a loss on my real estate? Listen, I was the same way when I got into this. I completely understand. Look, you're not going to be at a loss on your rental, but you're going to have what's called a paper loss with your real estate, okay? Now, when I first started in investing in syndications, it took me a while to grasp the concept that there were two types of losses. You have the paper loss, and then you have operational losses, all right? So you have paper losses and you have operational losses. So for instance, if you're running a rental operation, maybe you've got a duplex, or maybe you have like a fourplex, and let's say you have a fourplex, okay? And your expenses for running that fourplex is higher. It exceeds the income that's coming in, being brought in, okay? Your expenses are more than, what kind of sounds like the typical person, you know, their expenses is more than their income, typical American, right? So if you're running this fourplex and your expenses exceed the income that being brought in, the rental income, something's going to need to be changed quickly, right? Because you're at a operational loss in that fourplex. Now, in the fourplex, if you're cash flowing positive, and when it comes time, so you have more money coming in than going out, and when it's time to file your taxes, you're going to be showing a loss even though it's cash flow positive. You have what's called a rental loss, or it's also called a phantom loss, okay? This right here is what we get from depreciation. So depreciation is going to give us this rental or this phantom loss. Now, most of the smart business owners, they're actually leveraging depreciation to reduce their taxes when they're buying equipment. All right, when I started my dental practice, you know, I had to buy, you know, I started from scratch. I had to buy a bunch of equipment to equip my practice here, okay? My accountant, he instructed me, okay, well, you're buying all this equipment, and when you buy this equipment, now we can leverage depreciation, okay, to help with your taxes and income. So when you buy equipment, when you buy items inside of your business, inside of your practice, the government just doesn't just let you magically write the whole thing off in 1 year. Typically, you have to depreciate items that last longer than a year. So for instance, if you look at something like this computer that I'm at right now, if you look at the computer, we typically know that it's going to last longer than a year, right? Cell phones, same thing. Most cell phones are going to last longer than a year. The car that takes you to work, hopefully it's going to last longer than a year too, right? So the government has created some tax laws that allow you to write off things in 1 year. And you've probably heard of this before. You have code section 179 plus bonus depreciation. So again, the government has created these tax laws that allow you to write off things in 1 year. So you can use section 179 plus bonus depreciation, which many taxpayers have leveraged, but something like rental real estate, just like the computer, just like the cell phone, it's going to last longer than a year too. Okay. There's something called straight line depreciation in the tax code, which basically states that residential real estate is going to be depreciated in straight line, what they call straight line depreciation, 27.5 years, and 39 years for commercial, or this would be considered non-residential real estate, okay? 27.5 years, 39 years, okay? Now, I don't know about you, but 27.5 years and 39 years is a long time to wait, right? Now, once you start learning more about real estate investing and how this depreciation works, you're going to realize that there are certain taxpayers who actually go out there and they take depreciation, and they just take depreciation over the 27.5 years. And there's other taxpayers who just take the depreciation over the 39 years. But you're also going to realize that there are others who are really smart, who are taking depreciation in either 5, 7, 10, or 15 years, as opposed to the 27.5 and the 39 years that every other taxpayer might be taking with their depreciation over the allotted amount of time that the government has basically stipulated. All right. So you have a choice. You can do 27.5 or 39, or you can do 5, 7, 10, or 15. Now, pay attention. Here's one of the biggest tax saving secrets that they're not going to teach you in school, and that the tax code will actually allow you to realign your rental property so that rather than writing off all the components, okay? So let's say you have a single family home, okay? As you can tell, I'm not really an artist at all, okay? But again, pay attention, because here's a big secret for you. So the tax code allows you to realign your rental property so that rather than writing everything off, all the components that make up your property, you know, like the roof, you've got the doors, you've got the windows, you've got the flooring in there, you've got the lighting, you've got if you have a little bit of landscaping, you have all this stuff, all these components, okay? All these components like your roof, typically they don't last 27.5 years, and they don't last 39 years, but they do typically last 5, 7, 10, or 15 years, right? Depending on what item inside of your property that you're talking about. So if let's say we're talking about the roof, right? The roof is going to last 15 years, but in most people's cases, it's being written off over 27.5 years if you have residential property. Appliances. So if you have some appliances, which I hope you provide your renters with appliances. So if you have some appliances, typically they're depreciated over 5 to 7 years, right? Your refrigerator, stove, that sort of thing. But maybe your appliances, maybe your washer, your dryer, again, your refrigerator inside of your property, most of the time it's being written off at this 27.5 year mark. Look, why would I want to have all of these items inside of my rental property, inside of my house, that I'm going to have to replace every 5 to 10 years, written off for me over the course of 27.5 years? Does that make sense? That makes sense to you? So that's one of the reasons why I'm making these videos for you, because I want you to start learning and doing this research, and I want you to start questioning things, especially if you start doing this. If you see that your accountant is doing this a certain way, unless you're educated, you're not able to. And I'm not saying you've got to be an accountant. You have to learn enough to ask smart questions and start questioning things, okay? And because people back then started questioning things like what we just talked about, why would I wait 27.5 years when I can write something off that's only going to last me 5 or 7 years, right? And because people started doing this process, started questioning things like, why are they doing this? Why are they doing that? eventually it led to the actual tax code being changed. And one of those changes brought about something called a cost segregation study. Okay? Cost segregation study. Now, getting one of these studies means that you're going to go out and you're going to hire an engineering firm. Now, the one that I personally like and I like to work with, I'll put the link below this video. Okay? So you go out, you get a cost segregation study. It actually means that you're going to get the cost associated with your investment property, okay? The actual building structure. And then you're going to segregate out all the different components that we just talked about inside of this structure and outside of the structure. And then you're choosing to write them off over either 1, 5, 7, 10, 15, 27 and a half, or 39 years. When you go out and you hire this cost segregation firm, again, link below this video to the ones that I like to use, that are really good people, and they're really, really inexpensive compared to the other groups. When you go out and hire these groups, they're going to send somebody out to your property, and they're going to start taking pictures outside the property and inside of your property. And then from there, they're going to determine all of the different parts and pieces that basically make up your property, all the different little assets and everything like that. All of the real property, okay? All of the real property is what the government calls it. So all of this now can reallocate into the 1, 5, 7, 10, 15, 27 and a half, or 39-year bucket. Now on the tax returns, okay, on your tax returns, that creates a loss inside of, well, we got rid of it, but you have your, remember, you have your passive bucket, and this is your W-2. Okay, so on the tax returns, this is gonna create a loss over here on this side. But on the non-passive side, on your W-2 side, you're still going to have your active income. All right. Now, again, we're still in a situation where performing a cost segregation study, it still does not allow you to roll over the losses. Still doesn't allow it to come over here to offset your passive income, which is really what we're wanting to do. This is why you're here in the first place, to learn, right? Here is the $1 million question. How do we get around these passive activity loss rules? How do we get around these rules that the government created? Now, as with anything new, we first have to understand them, okay? So actually, there's 3 ways. Number 1, if your adjusted gross income is less than $150,000 a year, okay? More than likely, if you're watching this video, probably not going to qualify for this one. Probably your adjusted gross income is more than $150,000 a year. All right, that's number 1. Number 2, upon disposition, what does that, Jeff? What does that mean? Upon disposition or selling, when you go to sell your property, you can use the passive losses that have accumulated in the passive bucket to offset other forms of income, such as the capital gain that you're going to have from selling the property. Okay, the capital gain is the difference in price based on what you bought it for and what you sold it for. So, for example, if you buy a property for, let's say, $100,000, and then you turn around and you sell it for $150,000, then you're going to pay capital gains on that difference, and that difference is $50,000. All right, but you can use the losses to offset that capital gain. All right, that's number 2. Number 3 is by qualifying as a rep, also known as a real estate professional. This is also called, if you're gonna play the game, you got to know the lingo, right? It's also called rep status. Now, if you can get to the point where you can do this one, that, my friend, is when the real tax savings kick in. So here's the deal. Most high income professionals, we go to school for a long time, right? We go to school a long time to make good money. A lot of times we go into debt to do that. Okay, we do this, yet we never educate ourselves on how to keep it. We learn how to make it, but we're really bad or really poor at how to keep it. Now, it's not so much how much you make. That's what everybody's focused on, how much we make. But it's not so much what you make, it's what you keep. And by filing rep status, the government allows you to legally keep more of what you're making. Now, here's what's great about being a real estate professional. There's not any type of fancy test you have to take. Okay? So if you want to qualify, there's no dollar amount associated with qualifying. Okay? You do not have to make a certain amount of money a year to qualify. Test anybody? No. You don't have to take any more tests. Good news, right? There's no more schooling. There's no more exams. There's no more tests that you have to take. And you don't have to have you don't even have to have a background in real estate to have it. Okay? There's no type of background or anything like that. It basically, it comes down to 2 tests. Okay? So in order to unlock, this is locked up, right? You've got these losses. They're locked up over here. In order to unlock your passive activity losses so that you're able to turn them into non-passive losses, which is going to offset your dental income, your attorney income, your whatever income, your W-2 income. There's only 2 tests you need to pass. And that is this, the 750 hour test. Okay? You have to spend 150 hours in your real property, trade, or business. Okay? You have to spend 750 hours in your real property, trade, or business in which we've talked about this just a few minutes ago, materially participate. You have to spend 750 hours in real property, trade, or business in which you, my friend, materially participate. Now, you're probably wanting to know, Jeff, what does it mean to materially participate, and what is a real property, trade, or business? Now, remember, if you want to play the tax game, you have to educate yourself, right? Especially with the terminology that the IRS is actually giving us in the tax code to follow. Here's the steps you have to read, and then things can happen. So let's keep this very, very simply for you, okay? Let's break it down. Basically, material participation means that you are managing your own real estate, okay? The 750 hours part, well, that's pretty easy to understand. Now, if we break this down a little bit further, that's gonna come out to be roughly about 17 hours a week. You have to materially participate in your real property, trade, or business roughly 15 hours a week. That is going to give you the 750 hours. So for instance, if you're managing a rental, you have that fourplex we talked about, and you're the one that's actually managing it, you're running it, it's a real property, trade, or business, that's it, okay? That's number 1. That's the first test of 2 that you have to pass, real estate professional. Test number 2, it states that you need to spend more than half of our time is in this real property, trade, or business in which we materially participate. All right. But here's the thing. Most high income professionals, which could be business owners, high income W-2 people, dentists, physicians, attorneys, nurse anesthetists, or whatever, most don't have time to show the government that they're spending more than half of their time in real estate versus their normal job, right? Why? Because of this. Most of those people, they're working 40 hours a week, right? Which actually roughly comes out to being 8,000 hours a year. Now, what's going to happen is you're going to have to show the government that you're spending more time in real estate. That means if this is you right here, that means you're going to have to show them that you're spending at least, in this case, 41 hours a week in real property, trade, or business that you materially participate in. You have to spend more time in that than your W-2 job, and that's hard to do. I get that. Now, for those of you that are not married, this can be much easier to do. Excuse me, those of you that are married, this can be much easier to do, because if you have one spouse that works from home, doesn't work at all, or only works part-time, this is a perfect setup. This is a perfect situation to where they're the ones that can qualify for your family. They can qualify for these 2 tests, the 750 hours test and more than half the time test. Okay. Remember, the reason that you're doing this in the first place is to get to the point where what? Your passive losses can offset your active income. Now, what about all those people out there who don't qualify for this? What can you do to get to the point where your non-passive income is being offset by your passive losses that you might have generated? Let's say you've got a short-term rental, or you have a rental property or something. You do a cost segregation study on it, but you can't pass these tests. What can you do? Okay. Actually, there's a loophole. That's right. There's actually a loophole in the tax code. And we've actually talked about it in a separate video, which I'll link below this video. Okay. Now, in the tax code under section 469, giving you a little reading to do, section 469 in the IRS tax code. All right. The government states that short-term rental real estate, okay, STR, stuff that's on Airbnbs, VRBO, etc. 469 states short-term real estate does not count as a passive activity. It does not count as a passive activity. Let me say that again. The government states that short-term rentals do not qualify as a passive activity. They do not qualify as a passive activity. I'm repeating this. Do you think that's important? Short-term rentals do not qualify as a passive activity. I think we just found our way to get around this, right? That's the loophole, because with your short-term rental, you do not have to meet the reps two-part test, meaning you don't have to spend 750 hours. And you don't have to spend more than half of your time. You only need to materially participate in your short-term rental. That's it. By materially participating in your short-term rental and running the short-term rental for an average customer stay of, if you average people renting your short-term rental for 7 days or less, you can take the key, you can unlock the passive losses to offset your W-2 income. Why? Why can you do that again, Jeff? Well, what do we say? Short-term rentals, what about them? They do not qualify as a passive activity. Thus, you materially participate. Thus, average 7-day rental. Your customers stay an average of 7 days or less. Short-term rentals don't qualify as a passive activity. So then you can take the depreciation that you got from your cost segregation. You can take those losses that engineering firm, that's the link below this video, the engineering firm tells you you've got all this losses. Then you can take it to offset your W-2 income. Now, I know this can be confusing. Let's do an example to basically to bring all this home for you, okay? If you've seen some of my videos before, we've talked about my good friend, Dr. T, right? So we're going to use Dr. T. Dr. T is actually a dentist. He's a dentist in my hometown, okay? Now, he came to me and he said, Jeff, I've watched some of your videos, and I have one of these, and I hired one of the CPA groups that you recommend, started doing a little bit, I learned about real estate, got on some blogs, that sort of thing, and got the CPA group, and he learned how he could use real estate to offset his income. He did a cost segregation study on an investment property that he bought. Now, this property, it actually cost him $600,000. Okay, this is Dr. T. The property cost $600,000. He hired my cost seg group, link below this video, and they came out, took the pictures, remember, and they wound up telling him that he was going to have about $200,000 from the cost segregation study in paper losses, okay, after the depreciation. Now, again, this property cost $600,000. He ended up with about $200,000 in paper losses. So actually his dental income, his active income was roughly about $200,000 from his practice. Wife, stay-at-home mom, she didn't make any money. $200,000 is what he was bringing home. Okay, so the taxes he's already paying over here already. Now, if you have a W-2, remember, you know all about this. You have your what? You have your federal, you have your state, you have your Medicare, and your Social Security, right? If you're an employee, you know that when you get your check, all of these taxes are already taken out, right? So he's already paying that on his active income. Because he has this $200,000 loss over here on the passive loss side, with his rental real estate, guess what Dr. T is not going to do? He's not even going to have to pay any taxes over here on his dental side. Well, why is that? Well, it's because everything now is going to flow over. Remember, we have our passive income over here. So now we have this losses. So now everything's going to flow over. Okay. It's going to flow over to the other side. So if I'm leveraging a short-term rental, he's leveraging a short-term rental or qualify for rep status. Okay. So if you do that, it flows over. In his case, he's using the short-term rental tax loophole. Okay. So now everything's going to flow over to this side. That means that his $200,000 in active income from his dental practice is getting offset by the $200,000 loss. So in essence, my friend, Dr. T has wiped out his taxes for that year. He is at 0% taxable income. They don't teach you this in school, do they? No, they do not. Now, hopefully you understand that you can leverage passive losses with short-term rentals or by qualifying as a real estate professional, as long as you understand what material participation means and you also understand how much time you need or we need to spend in our rentals. Now, sometimes I'm asked if you have to be a real estate agent in order to become a real estate professional. No, it does not mean you have to be a real estate agent. Now, does getting your realtor's license help? Yeah, absolutely, because it contributes to the 750 hours in your real property trade or business, because now you have a real estate agent's business on top of managing your rental portfolio. Okay. Now, hopefully you understand a little bit better how you can use real estate to offset your W-2 income and pay less in taxes. Okay. If you want to learn more about this loophole that we talked about, because remember, most of you guys out there, you're not going to qualify or be able to qualify for real estate professional status unless you have a non-working spouse or a part-time working spouse that can do it for you. If you can, great. But if you cannot do that, your other option is to use this real estate tax loophole. If you want to learn more about how this works, check out this video. I go into a lot more depth about how you can use this Airbnb or short-term real estate tax loophole over here. I'll catch you over here.